some of those concepts, of course, that we're talking about relate to two of the three core principles we talk about at RadioActiveTrading.com. And just put this slide together because I knew this would probably come up in our discussion. When I was discussing this, it would come up in our discussion. But two of the three core principles of radioactive trading that really relate to all trading, whether you're doing covered calls, whether you're doing the married puts with the income methods, whether you're doing credit spreads or debit spreads, there's a level that you have to look at. And the first one, of course, is the ATM Bell Curve. I'll go back to the chain in a moment to illustrate this. But what the ATM Bell Curve shows you is let me change the color there. That's muted against the gray background. But the ATM Bell Curve, what it's going to show us is on any stock, any expiration, the at-the-money options, the ones that are closest to the current stock price, are going to have the highest extrinsic or time value. Not the highest total price, but the highest extrinsic or time value. Deep in the money options, when we were talking about the calls, we just illustrated the calls. So the deep in the money calls are going to have a higher intrinsic value, but a very low extrinsic value, that very low time. I talked about the low return, the 0.1% on that deep in the money covered call. But we were getting $25, $30, $35 because most of that is the intrinsic value, the difference in your strike price to the stock price. That's got to be fair market. You've got to be at least be making that. Why would I buy a stock at 500, sell a 400 call and take in $80? No, it has to be at least 100 for that trade to even start to making sense. Really, it's got to be about 105, 106 for it to make sense. Maybe that's a little bit high, but that's what we're talking about there. The difference in your stock price to the strike price of your call, stock price minus strike price, is your intrinsic value. Whatever's left over is the extrinsic or time. The out-of-the-money options, of course, are all time. Now, this is related to a call. I mean, the put, it would be reversed, but it's all time value / extrinsic value. Okay, so you're not getting as much premium deep here out of the money. You're not getting a lot of extrinsic value deep here in the money, even though the premium is higher because you've agreed to give up your shares of stock for that amount. But the highest time value, 50% probability of success, highest extrinsic, highest time value is right at the money. That's the at the money bell curve. And of course, the time decay curve. Why was I looking at 7 days out, 14 days out that we saw with the bull put picks of the day? And that's because in these strategies we're talking about, we want the time decay to work in our favor. In my bull put credit spread, selling a put out of the money, 80, 83, 86% probability, and buying one further below for a leverage return of that, 14, 15% we saw. 14.3% was the top one with that 86.7% probability. But I want to be 7 to 14 to 20 days out in time because I want the time decay to be working rapidly in my factor to where this is getting closer and closer to expiring worthless. Here further out in time, the time decay is much more slowly. Now, are there advantages of doing 30 to 60 day out at the money bear put debit spreads, calendar spread views, buying a 90 day out call, buying a 90 day out call and a calendar call spread or poor man's covered call and selling a 14 day out? Yeah, now we're talking about combinations. But in general, with two things, why I wanted to bring these up is that in general, fundamental rules of options trading, depending, of course, on your outlook for the underlying security. If I'm expecting a large gain, sure, I want to be buying calls that are deep out of the money because I'm looking for that higher percentage return, meaning a 12, 15, 20% gain in the stock price, playing an earnings play or something along those lines. But when I'm buying, I typically want to be buying on these outer wings to be paying into less time value. And when I'm selling, I want to be in this range of the at-the-money bell curve because I'm going to put the extrinsic value that's going to decay in my favor at the highest level. Also, when I'm buying options, I want to be maybe in this range. I want to have slower time decay and give more time for the stock to move in my desired direction. Whereas when I'm selling, I want to be shorter term to get more of that rapid time decay faster. I don't want to buy an option that's 7 days out in time, hoping the stock's going to rise on some news that's coming out and they delay it and say it's not coming out for another 2 weeks. Well, I've just lost everything I put into that. I lost 100% of what I put into that call. I'm probably going to roll out here and go out to 30, 60, or 90 days. So the time value decay is in my factor. We want to be buying here, of course, and selling here. And in this case, we want to be buying on the outer wings. Now, not too much to the point where you're just paying 5 cents for extrinsic value where I am on this curve, this sketch curve here. I don't want to be buying here. I want to be buying down here, maybe a few strikes out of the money or buying a few strikes in the money, depending on my expectation. We're talking about buying a call again, okay? And I want to be selling things here. But I want to be buying I want to be buying time that doesn't decay as rapidly against me. I want to be selling near term. And I want to be buying on the outside of these wings to pay into less time value. I'm going to be selling into this range as well. The ATM Bell Curve and the time decay curve. 3 of the core principles we talk about for radioactive trading in the blueprint. Why do we buy an in-the-money put? I buy a stock at 500. I'm buying a 520, maybe 515, 530 strike put. Not really. Better example would be $50. I'm buying a $50 stock, and I'm buying a 55 strike put for $8. Why am I buying an in-the-money put? Well, because it satisfies the ATM Bell Curve, the time decay curve, and the third core principle is forcing an ideal size trade, what we call fist. Because on the married put, that in the money, or our stock price is here, this is going to give me a controlled risk to 5 to 8%. But what am I also doing? And I know you guys know this, but I'm going to have a controlled risk of only 5 to 8% in single digits to avoid gambler's ruin. And I'm also going to be buying here 120, 130, 50, 180 days out in time so that I have slower time decay working against me. Now, cheaper put would be out of the money closer in. I might only pay, so here I mentioned I buy a stock at 50. It's a common example I use. I'm going to buy a put at the 55 strike, let's say 180 days out in time, 6 months to expiration. And this is going to cost me $8. So on a stock trading at 50, I'm going to put $58 or $5,800 into the trade for 100 shares. I bought this put. What does that guarantee? That guarantees at any time I can force someone to buy my shares of stock at 55. That's my guaranteed exit better than stop order. So the most I'm risking is $300 on a $5,800 investment guaranteed. And that's a 5.3% at risk, 5.26 essentially. That's why I like using this example. The numbers are easy. All right, so I'm risking 5.26%. Is my break even $58 per share? Why would I add that money into it? It's for the guaranteed protection. But this break even at 58, I don't care about right now. This is 180 days out in time. If the stock moves up $1 tomorrow, this 55 put I bought has a delta of maybe negative 0.5 or negative 0.55. So the stock moves up $1. I lose 55 cents on the put. I'm still positive 45 cents on Monday. I'm nowhere near $58. I'm at $50.45. I'm sorry, $51. My apologies. I'm at $51. Still $7 away from my break even, but I'm at a profit. This only counts at expiration. If I hold the position all the way to expiration, make no adjustments, manipulating the put option, selling calls, doing spreads inside the married put as discussed in the blueprint, yes, I'd need the stock to be trading at $58 to break even 6 months from now at that expiration. But I'm going to be doing other things. I'm going to follow the rules in the blueprint and do the management techniques. But these core principles, why do we buy an in-the-money put? Why do we buy it far out in time? Because it forces that ideal size trade. We're putting the time decay curve factor in our favor. And we're buying the puts here in the money to take advantage of the ATM Bell Curve. We want to buy here and I want to sell here. Sorry again for the green not showing up as well on the gray slate sketch drawing. But as you can see, these things apply to all trading. Covered calls. Yeah, I want to be selling here. Damn it, Mike. Change the pen color. There we go. I want to be selling here. Not really here, okay? as we saw on that chain for AVGO and Apple, 0.1% return, too deep in the money. Yes, high probability of making the return, but you're not meeting your trading goals. You got a 20% downside protection, 9% downside protection, fantastic, but you're not meeting your trading goals at 0.1% return, especially when you factor in even slight commission fees, right? We want to be slightly in the money here, maybe even slightly out of the money. We want to be in this range, but we still want to have the good probability. If our goal is to be assigned, get the return on our covered call with a reasonable probability and the return we want, we're going slightly in the money. I'm holding the position longer term. I'm trying to collect a dividend-like income. Maybe I am on this end of the ATM bell curve for selling calls. 4 or 5 strikes out of the money, 30 delta, 30% probability of being assigned, just collecting maybe 0.3, 0.4, 0.5%. That's fine, if that's your plan. In a raging market, yeah, out of the money covered calls, a raging bull market, out of the money covered calls are going to give you a higher return. But you're taking that chance because you have lower downside protection. Probably the range you want to be in. But when we're buying, we want to be sort of in this range. Okay, we want to be paying less into the time value. And when I'm buying, I want to be over here on me, giving myself more time. Okay, so promise real quick, a chain illustration. Doesn't matter what stock we go to, we can keep our regulars. Let's navigate back over to Power Options real quick. Take a look here. I'm going to stick with Apple. We're already there. And you'll see it. It's obvious. And I'm sure you've seen it before when we're talking about the ATM bell curve. Let's go out to let's go 2 weeks out. Black Friday, November 28th, shortened market day. Markets closed on the 27th. And what I want to do, I want to be calls only. And we want this column here, midpoint time value. And what do I see? We know our stock's at 272.41. 272.50 is our at the money strike. Our midpoint time value, what do we see? Exactly as we said, the highest midpoint time value. Change the pen color again. Sorry folks. Going from one screen to another. Let's change that pen color again. There we go. 1.8%. Now that's for 14 days out. So the at the money is at 1.8% extrinsic with a price of midpoint of 483. Now the 262.50 has a midpoint price of 1203. But the time value, the extrinsic value is only 0.8%. And out here to 280, price of 176. That's all extrinsic value. There's no intrinsic value. Time value of 0.9%. So this 262.50, where are we? We're $10.09 in the money. So the extrinsic value, time value, is only about $2. Here, all extrinsic at 483. You can see the curve right there. 0.3, 0.4, 0.5, 0.7, 0.8, 0.9, 1.8, 1.3, 999. There's the ATM bell curve in column format. Any expiration, any stock, doesn't matter. Let's go 10 months out in time. Let's go 8 months out in time, okay? Stay with Apple. You'll see the exact same thing on that midpoint time value. I'm going to go out to 280, all right? And let's go back to the 30 in the money strike. There, so we see the wider view. Now, we don't have a 250 strike here. It's too far out in time. We just have the 10-point strikes. The 272.50 will show up as we get closer to this August expiration, 2026. But the 270 closest, right? We're at 272.41. The next strike is 280. That's closest to at the money, 31.60 premium. Not as high as 50.78 for the 240, but that's $32 in the money. It's only about $18 a time premium. And of course, out here to the 310, well, same lateral move. So we'll go 30 down, we'll go 30 up to the 300, midpoint of 1770. What do we see for the midpoint time value? Highest peak right here, right at the money, closest strike, 270. And then we start to have the fade down slowly, 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 slowly. And we're peaked here, start to fade slowly, 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 okay? That's the ATM bell curve in action. We want to be selling somewhere in this range to maximize the time premium with our spreads, with our covered calls, cash secured naked puts, but you still want the probability and protection you want. That's important, right? So when I do an in-the-money covered call, like I said, Ernie might be looking at the 65, 68% probability. And this is far out in time, but hey, good downside protection, good potential percent return for a 280-day trade. But when I'm buying options, depending on the movement I'm expecting, we're buying on the outside wing, so I'm paying into less extrinsic premium. I'm going to be buying right at the money. Now, I would buy right at the money if I'm expecting only a 5, 6, or 7% move for calls, long calls or long puts. But I want to be selling closer to at the money with the probability I want for the trade or the strategy that I'm using. All things going important, but that's just a brief discussion, and it wasn't that brief, I understand. I started off with the basic comparison of what is extrinsic and intrinsic, and how that matters when you're looking at these premiums, how you can easily view your desired returns that you want for covered call positions, cash secured naked puts, what your goals and targets are using the Power Options option chain.